Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video I'm going to go over one undervalued stock. This company is I believe one of the best companies out there when it comes to growth as well as mature company. Before we do that, I'm going to talk about a couple of things, and we want to see how the markets have done last week, because a week ago we were heading almost, we were around here when it comes to the extreme the fear and greed index. So we were here around, I think it was about 25 or whatever it was, extreme fear. But right now we are coming back towards again fear. Before you know, it'll be neutral, and before you know, we will be heading to extreme greed. It could happen, or it could, things could change easily, and we might go back to the other way. Again, this is not a way of investing. We don't really care what this means. Okay, it kind of gives us an idea what investors are thinking about, but we don't really pay too much attention to this. Okay, and the reason I always share with you guys is just to kind of give you an idea where the Wall Street and the retail investors are thinking about, but it's not a way of investing, if you like. So I wouldn't pay too much attention to it. It goes up and down, but it gives us at least an idea of the sentiment of where what the investors are thinking about right now. Next week there's a few companies that are still a few more companies are reporting. The only one that I really care is Medtronic that's reporting. Lowe's, we'll see what they say. Home Depot was okay, so Lowe's probably be similar. But yeah, so I think Medtronic is the only company that I own here that is reporting. Palo Alto Networks, we'll see what they say about the general markets and so on, as well as of course Zoom and Snowflakes and a couple of other companies that we do not own are also reporting. So nothing really important in terms of things that we need to look forward to next week. And just this week, in terms of the S&P 500, you can see we were up about 4%, which is quite nice for in comparison to the 2 weeks prior. Okay, and then Dow Jones Industrial was about 3.5%. The Nasdaq 100 was about almost 6%, and the FTSE 100 is just about 2%. Guys, if you enjoy the content that we basically putting out there week in week out, it would be genuinely so helpful if you can just press that like button. Okay, it genuinely helps. The more likes the video has, hopefully the more the algorithm will be nicer to that video, and it will reach more brothers and sisters. So the only way, I'm trying to kind of reach out to as many Muslims out there, and by just you liking that video, you're actually helping the journey. You're helping me, and you're helping, of course, the ummah as there, and the more ummah that are out there, inshallah. So please, genuinely appreciate it. So if you can like that videos and subscribe to the channel, there's about 50% of you guys that are not subscribed yet. Please do so if you can, and join us in the Patreon account where it will cost you only 15p. You get all the buys and sales and everything else that comes with it. So that would be really nice if you could do that. Right now, let's talk about the company we're here for today, and that's Adobe. Adobe doesn't need an introduction when it comes to content creation, when it comes to things like the PDFs. They are the company that actually came up with all these PDFs and everything else that the company sells, and they're the pioneers when it comes to that market. So what I want to do is just kind of, as you can see here, the ratings from Seeking Alpha Analyst, the Wall Street, the quant system that they use, all of them are saying is a buy. So we're going to look at the financials, and then I'm going to give you the breakdown of the discounted cash flow using discounted cash flow model and so on, to show you how basically whether it's a buy, sell, hold, and I will tell you exactly what I would be personally doing, inshallah, moving forward with this company, because I don't own it in this portfolio, but I do own it in other places, and inshallah I'll share that with you guys in a second. Right, let's talk about the company first. As you know, of course, when it comes to content creators, I said to you, like PDFs and so on, or the software that we use is the company. Every YouTuber out there or whatever uses the software to edit their videos and to put together, nice whatever. Our company, the company that I work for, we use every single product this company creates, more or less, and subscription wise is one of those things we don't really think about it. The company just renews it every single year. It genuinely just we don't even think about it, and then we just get a new suite of products that this company creates. So for that reason, I really like the business. Okay, I like the SaaS model of this company. Currently trading $553 per share. EPS is about 11. 245 billion market cap. So they are a really huge company, and probably one of the best when it comes to the type of software this company has. They have a wide economic moat. Currently, the beta is slightly higher than 1. P about 49, let's call it, but maybe 50 right now. But the forward P is about 30, and the 5-year average, okay, is about 38. So based on the 5-year average, it actually seems basically very expensive right now when based on that PE. The sector is about 26 right now. The S&P 500 about 23, 24 I think right now. Price to free cash flow is about 38, so closer to the 5-year average. And in terms of free cash flow, we're looking at $6.3 billion of free cash flow. Free cash flow compound annual growth rate is for the last 5 years, we're looking at about 11%. And free cash flow yield of over to almost the 3%, and free cash flow margin of 31%. So based on this, I really like the company. I like the free cash flow, the compound annual growth rate about 11%, which is very, very good. In terms of profitability and what the management are doing to the business, okay, growing that business, and of course using some of the capital they get from us, reinvesting in the business to generate more returns for all of us. That's basically what we're after. And as you can see here, 25% profit margin, operating margin is about 35, return on equity 34, return on invested capital 35. And the last 10 years this company on annually has returned 20% or almost 21% to shareholders. Remember, they don't pay any dividends, so that's just price. Okay, the revenue, the compound annual growth rate for the last 5 years is about 15%, and the EPS is about 22%. So this is absolutely amazing, and I don't genuinely think anything is going to happen to this company to kind of stop this kind of growth for moving forward. Despite the AI and everything else out there, they are playing, you know, they're a big part of the companies that are using generative AI. So they got the Firefly and so on. So I don't have to worry about that at all. Current ratio 1.1. So what we're normally looking for is above 1, which then means the current assets the company has is basically covers the current liabilities, which is quite nice for the next 12 months or so. Now, the growth for expected to grow about 13% every single year for the next 5 years, which is absolutely huge. Now, current price we've already seen $553 per share. According to Morningstar, is basically this is the fair value right now. It's about 16% discounted right now. According to Simply Wall Street, 27% discounted right, 737. That's absolutely amazing. I think they both these two use discounted cash flow models, okay, to come up with valuation. Whereas these guys, they actually sampling all the analysts, basically the target from the analyst, and then average them out. That's why I say it's basically target price, okay, and so on. So the average target price from TipRank is up at 611, 14% upside, moderate buy right now. From Seeking Alpha, it's about 600, about 13% upside from where we are now, and is actually a buy. Now, from Sharia compliance side of things, absolutely nothing to worry about. And one thing I love about this company is the fact that they're buying back their own shares. Why is this important? I love the companies that buy back their own shares when the stock is actually cheap, not when the stock is expensive, because that's just that will be useless. But when the stocks are actually trading lower. So right now, maybe it will be a good time if this company is actually undervalued to buy back their own shares. And based on this, it looks like it's undervalued, right? So buying back their own shares means the one share of this company that you had the previous year is basically is now worth more. So you're increasing basically your share by every year by basically they increasing your share by buying back their own shares, which is really, really good. I like that. Now, if we compare this company with the S&P 500, as you can see here, we're just looking for total returns. But remember, total, in fact, maybe we'll just look for the price because this company does not even pay any dividends. So price-wise, as you can see here, for 1 year, it's about 7%. The S&P 500 about 26%. So the company, in fact, is down quite a lot. And I'll show you in a second. For year to date, I think it's down about 7%. There we go, 7% down a year to date, whereas the S&P 500 is actually since January of this year has given us, about 16%. So the stock's still down year to date. Now, for the last 3 years, it's down about 13%, which is absolutely crazy when you think about it, okay? Just the price-wise, so 23% when it comes to S&P 500. But last 5 years, 92%, 92%. So the S&P 500 and this company more or less the same, slightly higher when it comes to S&P 500, the Adobe. But then when you look at it for the last 10 years, 668% up in comparison to 180% from the S&P 500. So this is why I always say to you, if it's a good company, of course, like this guy does not give us a true value for this company or true reflection of what the company is doing or the management is doing. Sometimes it's better to hold their stock for a very long time if you think it's actually revenue and everything else is actually heading in the right direction. Now, showing you the revenue side of things, you can see here from $4 billion in 2014 to right now $20 billion. So $16 billion growth from basically since 2014. The cost of that revenue, okay, look at it right now, basically is all $2.4 billion. So they're making about 20.4 billion, they're spending 2.4, and they're taking gross profit of $18 billion, which is absolutely huge. And remember, this company, because it's their software, they no longer need to burn everything into CDs and packaging, send it out there like back in the days. Right now, you pay for it and you go online, you download this the Creative Suite thing, and then all of a sudden you can just install any software you want from the company and you just pay for it. But so that is absolutely amazing. I love that. And if you know me, I absolutely love this because there's not too much overheads. Now, after they've paid some taxes, research and development and all of these things, we're looking for the net income, which is about $5 billion, which is absolutely fine. Okay. And then some of that $5 billion then becomes the free cash flow that we've seen here. Okay. There we go, $6.3 billion, and that's why they have a nice, excellent free cash flow yield and free cash flow margin, which is absolutely fine. Now, final thing I want to show you is I've added everything together. So we got the Morningstar valuation, we got Seeking Alpha, we got Simply Wall Street, we got multiples valuation model, which I created, and the discount to cash flow model, which I also used, and average the 5 out, you get $625 per share right now, as in the average intrinsic value for the company. Current price we know is $553. That gives us about 13% from where we are now. Now, of course, you need a bit margin of safety. You always have to have a margin of safety, and if you add margin of safety of 10%, you still undervalued. Okay, $563 per share. You might say this is a very risky company. I will need at least 15%. So you might just wait for a few weeks just to hit that. Maybe if the stock goes down to 532 from that 553, okay, which is not far off, okay, then you might be able to get that basically a few percentage off. So there you have it. That's Adobe. That's the company that I wanted to talk to you guys about. Of course, always make sure that you are doing your own research. And I'm not a financial advisor. And the other thing is I wanted to say is I do own, if you're part of the community, you will know that I do own basically Adobe in the family portfolio. You can check that out if you join us here, InshaAllah, and you get access to all of these things, including the Sharia compliant investing ebook as well as the disco, InshaAllah. Have a wonderful day. Assalamu Alaikum.